Welcome to another deep dive here at the Deep Dive. Today, we're tackling a topic that, well, it often sparks a bit of discomfort, maybe even unease, especially, with economic downturns seeming like they're always just around the corner. For most people, a recession means tightening belts, maybe job worries, just general anxiety. But
Mhm.
what happens if we look at a very specific group that people often just call the rich? You start to see something really counterintuitive. They consistently find ways not just to get through these times, but to actually thrive, to significantly increase their wealth. Okay, let's unpack this. Our mission today is really to pull back the curtain on these strategies. Some of them are pretty unconventional. We want to give you a shortcut, sort of a concentrated dose of insight into the mechanisms that let this happen. We've looked at some really insightful source material with specific examples, detailed analyses. It paints a clear picture. It's going to be eye-opening, maybe a little unsettling too, as we explore how opportunity can bloom right in the middle of a crisis.
Yeah, and the counterintuitive thing you mentioned, it's really what's so fascinating here, right? While, the vast majority are just bracing for impact, trying to cut losses, survive. For a select few, the ones with the right resources, the right mindset, recessions are times of immense opportunity, maybe even unparalleled opportunity. And it's not random. These strategies, they often deliberately exploit market inefficiencies, or they leverage systemic weaknesses that just become way more obvious when the economy is under stress. Our goal here, just to be clear, isn't judgment. We're not endorsing these things. It's more about taking a dispassionate look, an analytical look at how they work, and understanding the sort of economic principles underneath it all. It's about getting a clearer, more objective picture of the financial world that, frankly, many operate in, but few really grasped.
Absolutely. So let's dive right into these strategies. We'll start with how the wealthy strategically exploit the economic systems that are already in place. First up, and this one always gets people talking, government bailouts, the ultimate safety net. Now, this might sound almost, too good to be true, but it's very real. Happens again and again.
Oh, absolutely. The core idea revolves around certain huge interconnected businesses.
Yeah.
They get labeled too big to fail.
Mm-hmm.
And that's not just a phrase. It means if these companies look like they're about to collapse, the government steps in, often with massive financial lifelines. Some people call it free money. The justification is usually to stop a bigger systemic collapse that could hurt the whole economy.
And it's kind of remarkable what that allows these companies to do, isn't it, in terms of how they operate? They can use enormous leverage, right? Borrowing tons of money compared to their own.
Exactly. High leverage.
Pushing financial risk right to the edge. Because they know if things go really bad, the government cavalry will probably ride in. It's this incredible safety net, this risk mitigation that just isn't there for, regular people or smaller businesses.
Precisely. And the benefit for the rich, especially those who own big chunks of these companies or have major investments, it's crystal clear. Their money, their assets in these huge corporations, they get protected, not by the market, but by the government stepping in. Think back to 2008, the banking sector. Governments all over the world jumped in to stop a total meltdown. They argued these banks were vital. Without them, the whole system, from savings accounts to global trade, could have just seized up. But the deeper thing here is this too big to fail net. It's not just about survival. It fundamentally changes how they calculate risk. They can be super aggressive when times are good, chase high returns, knowing that a catastrophic downside, well, that risk gets pushed onto the taxpayer. So they often come out of these crises not just alive, but stronger, maybe having bought up competitors, solidifying their spot, often on really good terms.
And we saw that again, maybe even more clearly, right after the first COVID shock in 2020. Airline companies, they were bleeding cash, travel just stopped.
Completely stopped.
But they got huge government aid packages to keep them going. They were called essential infrastructure, critical for connectivity. The idea was to make sure they were still there when things picked up again.
Yeah, preserving the system, even if it means bailing out the players inside it.
And if you compare that to what happened to an individual, if someone faces bankruptcy or loses their job,
Oh, it's night and day.
it highlights such a stark difference in the rules, the consequences.
For individuals, financial collapse can mean losing almost everything. Very few safety nets. For these massive companies, the argument about saving jobs, avoiding a bigger crash, often leads straight to government help.
Which really does raise that important question, doesn't it, about the fairness of these systems?
It does. Who ultimately carries the risk when these huge players push the limits? It's a complex ethical point right at the heart of modern capitalism,
It really is something to think about. Okay, shifting from direct government help, let's look at another way economic systems are used. This time, finding safety and even profit inside the government's own finances. That brings us to strategy number 2. Government bonds, safe harbors in stormy seas. This is about investing in government debt. It becomes super attractive when everything else feels uncertain.
Exactly. When markets are volatile, stocks are dropping, other investments feel, frankly, terrifying. People with a lot of capital need a safe place to put it. A place where it won't just disappear, but ideally keeps growing, even a little. Government bonds are perfect for that. Essentially, you're lending money to the government. In return, they promise to pay you interest over time and then give you your original money back when the bond matures.
And the big draw is the safety factor, isn't it? They're seen as incredibly secure.
Extremely secure.
Because getting paid back really only depends on the government continuing to exist. Unless the whole country collapses, you get your money.
Right.
So it offers this consistent, predictable, very safe return exactly when other things, like stocks or real estate, are bouncing all over the place or losing value fast. It's about keeping your capital safe and getting some modest, secure growth while the storm rages elsewhere.
That's absolutely right. And looking at the bigger picture, economically developed countries use bonds all the time to manage their markets. It's a sophisticated tool. They can issue bonds to pull money out of the system or buy them back to put money in. Helps manage liquidity. And it lets them stimulate or cool the economy without just, printing tons of new money, which, as we'll get into, can cause inflation problems. The key phrase is little to no risk. That makes bonds incredibly attractive when other assets are falling. It lets the wealthy hold on to their capital, even grow it a bit, without getting caught up in the market turbulence. It's a strategic move. Preserve and grow gently.
Okay, next up, this one. This one often stirs debate because of the implications. Dumping or shorting stock before crash the predictive advantage. This is about using foresight, and sometimes, let's be honest, maybe information that isn't widely available, to profit when markets are expected to fall.
Yeah, this requires a pretty advanced level of market awareness.
Yeah.
The wealthy often have access to sophisticated analysis, proprietary data, extensive networks of economists, industry insiders. They're constantly monitoring trends, global events, really granular economic data. The goal is to think, 1, 2, maybe even 3 steps ahead of the general public. So the mechanism is either selling off stocks they think are vulnerable before a crisis hits, basically dodging the losses, or, more aggressively, shorting the market.
Right, and shorting, for anyone unfamiliar, it's basically betting that a stock's price or the whole market is going to go down. You borrow shares, sell them immediately, wait for the price to drop, then buy them back cheaper to return them. You pocket the difference. So this lets people with that foresight not just avoid losses, but actually make huge profits while the market is crashing, turning crisis into a personal windfall.
Precisely, and there are some really striking examples. Remember the start of the coronavirus pandemic? Billionaire Bill Ackman, head of Pershing Square Capital Management. The reports say he turned a $27 million bet on credit default swaps.
Which is basically insurance against companies defaulting.
Right. Insurance that pays out big in a downturn. He turned that $27 million into something like $2.6 billion.
Wow.
He was very public about predicting the crash that made his move. Shows what conviction plus capital can do during panic. And more broadly, sources suggest short sellers as a group made over $50 billion during that whole coronavirus sell-off. Shows the scale of this.
That's just an incredible return in such a short time. But then there are the examples that feel a bit more murky, right? The ones raising ethical flags about fairness and information. Our source points to several U.S. politicians. Republicans Richard Burr, Kelly Loeffler, James Inhofe, and Democrat Dianne Feinstein. Apparently, they collectively sold off stocks, maybe up to $1 million worth, in late January, early February 2020.
Which was critical timing.
Critically, yeah. Weeks before the public really understood how bad COVID could be for the economy. This wasn't just market insight, was it? Their positions gave them access to early, non-public briefings about the pandemic.
And the analysis here is so important. Thinking ahead, spotting risks, that's smart investing, no question. But the ethical questions pop up when that foresight seems undeniably linked to privileged, non-public information. It really highlights a huge power imbalance in who knows what, and how that knowledge can translate into massive financial gain, especially when the public is vulnerable. This strategy relies on quick, decisive action based on superior insight, sometimes maybe exclusive insight. So the question for society is, where's the line between diligent research and potentially misusing public trust for private profit? It's a debate that keeps coming back, especially in crises.
Definitely. Okay, so from predicting downturns and profiting from the initial shock, let's pivot. Let's talk about capitalizing on the downturn itself. Our next big section is all about acquiring assets at deep discounts. And first, under that umbrella, buying stocks at the bottom, the Black Friday effect.
Right, this is a classic contrarian move.
Yeah.
It runs totally counter to basic human fear psychology. During a major market crash, most people are panicking. They're selling desperately to stop losses, or maybe just hoarding toilet paper, right? Out of fear.
Yeah.
The wealthy, or at least those with this mindset, see it completely differently. They see a massive sale, like Black Friday, but for assets. They use their cash reserves strategically to buy stocks, other assets that are suddenly super cheap just because everyone else is scared.
It really is a profound shift in mindset, isn't it? Fear versus opportunity. Our source even mentions benefiting personally from this, getting like over 40% returns by jumping in during markets doom and gloom. The core idea is simple. Buy these undervalued assets cheap. Position yourself for big gains when the economy eventually turns around and prices bounce back.
It's having the guts to buy when everyone else is selling, trusting that good companies will eventually recover their value.
But it takes certain things that most people just don't have, right?
Absolutely. Critical prerequisites. First, you need that long-haul view. You have to be ready to hold these things for years, maybe not just weeks or months. Wait for the real recovery.
Patience.
Patience, yes. And second, crucially, you need cash. Lots of liquid cash that you don't need for, rent or groceries. Cash to make the buys, but also enough cushion to ride out the rest of the downturn without being forced to sell what you just bought.
So it's not just buy low, sell high.
Not at all. It's the psychological discipline, the access to significant ready money, and that long-term vision. That's what lets them act decisively while others are frozen by fear. They're capitalizing on what's essentially a fire sale on future growth. For many, a crash is a disaster. For the wealthy with this approach, it's a generational buying opportunity.
Okay, moving beyond just stocks, let's talk about buying bankrupt companies, strategic consolidation. This is about sweeping in when businesses fail, picking up valuable assets, infrastructure, maybe even talent for scraps, as the source puts it.
Yeah, this is an incredibly powerful move, usually done by big companies or investment funds, the ones with really strong financials. They basically sit on the sidelines during a really bad downturn. They watch patiently as competitors, suppliers, maybe even related businesses start to collapse under the pressure. Once a company goes under, the well-funded player can jump in and buy its valuable stuff. We're talking physical buildings, machinery, patents, trademarks, maybe even their trained workforce, their raw materials. All for pennies on the dollar compared to what it originally cost.
So it's a way to grow super fast, consolidate the market without paying the usual high price of building from scratch or buying a healthy, expensive rival.
Exactly. You're basically buying a ready-made operation, just one that's currently broken.
Think about the airlines again, or cruise lines in 2020. They were losing unbelievable amounts of money because nobody was traveling.
Right.
But their core assets, the planes, the ships, they still had huge intrinsic value. They just needed to be used again eventually. For an investor with deep pockets, those were temporarily unprofitable assets, but with fundamental long-term worth.
Precisely. Those assets, even though they were caught in a severe liquidity crisis or just weren't making money then, still had fundamental value. For those with the capital to buy them and the patience to wait for the rebound, they became prime targets. It really shows the ability to distinguish between a temporary cash flow problem, where the core business is sound but just needs money now, and a permanent loss of value, where the asset itself is truly worthless. The wealthy are often very good at making that call, seeing past the current mess to the future potential.
Now, maybe one of the most visible, relatable examples of buying cheap during a downturn, buying real estate dirt cheap, capitalizing on distress.
Oh yeah, real estate is almost always a prime target in recessions. Its value gets hit directly and quickly by falling demand and rising financial stress among owners. The cycle is pretty clear. Recession hits, people lose jobs, economic activity slows way down, demand for property plummets, prices drop, especially for maybe luxury homes or commercial space.
And this drop in demand creates a vacuum that the rich, the ones with cash, are ready to fill. While regular folks are maybe facing unemployment, struggling with mortgages, or just can't afford to buy,
Right.
those with plenty of cash step in. They buy up valuable properties, homes, apartments, office buildings, land at huge discounts. This gets really intense for developers, right? People who built projects using loans, assuming demand would stay high.
Oh, definitely. When demand vanishes, the banks start calling. Often forces fire sales just so the bank can get something back. creates golden opportunities for cash buyers.
It just shows that stark difference again. For many, a property crash is ruin. For the wealthy, it's maybe the best chance they'll ever get to buy prime assets cheap.
Exactly. It's leveraging the distress of others, essentially. It connects right back to that basic supply and demand cycle. It shows how wealth, especially liquid cash, lets you be a powerful countercyclical buyer. You buy when everyone else has to sell or simply can't buy. And that countercyclical move positions them perfectly for huge gains when the market eventually recovers and property values climb back up. It's seeing opportunity where others just see disaster.
Okay, let's shift gears a bit. Let's talk about optimizing financial flows and investments. Because it's not just what you buy, it's also about actively managing what you already have. Which brings us to renegotiate everything the power of leverage. And here's where it gets really interesting because it speaks to a whole mindset.
Yeah, this is a big one. The core idea is using the vulnerability of everyone else, businesses, banks, service providers, during a recession to get better deals on existing agreements. Think about it. When the economy's tanking, every business is fighting to survive, desperate for revenue. Lenders really want to avoid defaults. Service providers are super anxious to keep their important clients, the ones who represent stable income.
And the wealthy, with their significant money, their track record, often long-standing relationships, they use this desperation. They actively pick up the phone. They'll try to refinance loans at much lower rates, renegotiate contracts with suppliers for better terms, get deals from service providers they'd never get in good times. It's based on this fundamental belief that everything is negotiable, especially when the other side is feeling the pressure.
It's not necessarily about being mean or exploitative. It's about being opportunistic.
Yeah.
Understanding the power dynamics in that moment.
Exactly.
And by doing this, by proactively renegotiating, they're not just cutting costs and boosting returns on what they already own. They're also freeing up significant amounts of capital, money that was maybe tied up in higher interest payments or bad contract terms. And that newly freed up cash, it can then be deployed into those other opportunities the downturn creates, buying cheap assets, funding new things. It amplifies their gains.
Right.
It's a really proactive, shrewd way to manage assets and debts. Turning a period of general economic pain into one of personal financial expansion, it really speaks to the power of having cash and foresight.
Okay, next up. This one might surprise people because it flips a common idea on its head. Insurance, A, strategic investment, and bet. For the wealthy, this isn't always just about protection. It can actually be a way to make money during a crisis.
It's really a two-sided strategy. Shows how one financial tool can be used in very different ways. On one hand, yes, insurance plays its usual protective role, but sometimes on a scale that's hard to imagine. We're talking about proactively buying insurance for events that are super unlikely but would have a massive impact if they happened.
Like a global pandemic.
Exactly. The Wimbledon example is incredible. For nearly 20 years, starting around 2003, they apparently paid something like $30 million in premiums for pandemic insurance.
Wow, that's foresight.
Huge foresight. Then COVID hits in 2020, forces them to cancel the tournament for the first time since World War II, and they reportedly received a payout of around $140 million.
Unbelievable.
It turned what most see as just a cost into an incredibly profitable investment in risk management.
That's an amazing return on basically a long-shot bet against a specific, rare global disaster. Shows deep, long-term thinking. But then there's the other side. The more speculative side, almost predatory maybe, where insurance companies themselves become the target when they're struggling because of huge claims, like after massive wildfires or hurricanes.
This is where the speculative angle comes in, yeah. Smart hedge funds, wealthy investors, they'll carefully identify insurance companies that look vulnerable. Maybe they have too much exposure to a certain type of disaster, or they're facing just an overwhelming number of claims that could break them financially.
Okay.
Then they take a short position on these companies' stocks. They bet against the stock price. They figure the insurer's value is going to plummet because of all the money they have to pay out, maybe even facing bankruptcy.
And they profit if the stock goes down.
They profit handsomely as the company's value drops. So it really highlights that dual nature of insurance. For some, it's risk management. For others, it's a target for sophisticated financial betting, turning widespread misfortune into their own game.
Okay, let's talk about borrowing money. Low interest rates, borrowing on the cheap. This strategy takes advantage of the fact that banks get desperate to lend money when the economy slows down. And it's a massive advantage for those with good credit.
Yeah, when the whole economy grinds to a halt, banks are in a tough spot too.
Yeah.
Less activity means less demand for loans at the usual profitable rates. So to get things moving again, to attract business, central banks and commercial banks start cutting interest rates, sometimes down to almost nothing, historically low levels. For wealthy individuals or companies with strong credit histories, proven track records, this is a huge opportunity. They can borrow money incredibly cheap, maybe even near zero interest.
And this is exactly where having that great credit score, that history of paying back big loans, really pays off, that competitive advantage.
Absolutely shines.
It lets them refinance existing debt mortgages, business loans, investment loans at much lower costs. That immediately frees up cash that was going to high interest payments. But maybe even more important, it lets them borrow new money super cheap, specifically to jump on those other opportunities the downturn creates. Buying assets cheap, funding new ventures, acquiring those bankrupt companies we talked about.
Right.
All using incredibly inexpensive capital.
Exactly. The bank is willing to lend them large sums for these things precisely because they've proven they can pay it back. They're seen as low-risk borrowers even when the overall economy feels high risk. And if you connect that to the bigger picture, sure, low interest rates are meant to stimulate the whole economy, encourage everyone to spend and invest, but they disproportionately benefit those who already have established credit and significant capital.
Right.
It effectively lets the rich get richer by using cheap, almost free debt to acquire even more assets. It's a fundamental tool for building wealth during recessions.
Another really interesting strategy, especially when things feel really unstable, is move money to tax havens to store value guarding against inflation. This is all about protecting wealth from governments potentially devaluing their own currency through inflation.
Yeah, one of the biggest underlying fears for anyone holding significant wealth is inflation eroding its buying power, just making their money worth less over time. And inflation often happens when governments print massive amounts of new money and pump it into the economy. It's a standard playbook move, really, used for a century to try and stabilize things, stimulate recovery during bad recessions or crises. But the side effect is all that new money can devalue the existing money.
And the scale of this money printing can be pretty mind-boggling. You look at the Great Recession, the U.S. Fed printed something like $3.5 trillion over 6 years. Then the response to COVID, the Fed printed over half that amount, more than $4 trillion in just a few months.
Astronomical numbers.
The rich see this coming. They anticipate the inflationary pressure, and they take steps to protect their wealth.
That's exactly right. Their strategies are all about diversification and protection. Finding assets, finding places that are less tied to one country's economic decisions. So, yeah, moving significant money offshore to tax havens, places with friendly tax laws, strong financial privacy, that's part of it, but also converting wealth into tangible things like physical gold, silver, historically seen as stores of value during turmoil. They also look at digital assets, cryptocurrencies, especially ones designed to be stable or resist inflation, and diversifying into foreign currencies seen as more stable, like the Swiss franc, maybe the Norwegian krone, currencies backed by strong economies, less likely to devalue quickly.
So what does this all mean for them?
Fundamentally, it's about protecting their purchasing power, making sure the wealth they've built isn't just silently eroded by domestic economic policy and inflation.
Okay, let's look now at how the rich adapt to the changing economic landscape. Position themselves not just to survive, but really to capitalize on the eventual recovery. This section has some real insights, starting with a pretty stark reality. More people. Looking for work means it's cheaper to do business labor market dynamics.
Yeah, recessions are obviously devastating for workers, millions of them. But ironically, they can actually be beneficial for business owners, for investors who manage to keep things running or even start new things. The mechanism is simple, even if it feels harsh. Mass layoffs, businesses closing. It drastically increases the number of people looking for work. This creates a big imbalance of power in the job market. Suddenly, employers have the upper hand.
So if you're hiring, you have a lot more leverage. You can potentially hire talented people for lower wages than you'd have paid when the economy was booming.
Exactly.
And maybe just as importantly, your current employees, they're much less likely to ask for raises or push for better conditions because job security feels so fragile. Everyone's worried about being next. This lets businesses, especially those owned or controlled by the rich, really trim the fat, as they say, operate leaner, cut operational costs significantly.
And cutting those labor costs, which are often a huge expense, can make a business much more profitable, sometimes dramatically more profitable, even if revenues are flat or falling because of the recession. Now, obviously, this creates a really volatile, stressful situation for workers, no question. But for the business owners, the investors, it's a chance to optimize their costs, boost their margins, and get ready for stronger growth when the economy does turn around. It's a tough dynamic, but it's a real economic force during high unemployment.
Sticking with government influence, but looking at it from the other side, revenue for businesses. Our next strategy, securing contracts with the government, the recession-proof business, using steady government spending as a reliable income source.
Right. To fight recessions, create jobs. Governments at all levels almost always launch big infrastructure projects. They allocate huge amounts of money for public services, healthcare, defense, you name it. And this money gets distributed through contracts given to private companies.
And since the rich often own or have major investments in these very companies, construction firms, tech service providers, defense contractors, they benefit directly from these government contracts, which are seen as pretty much recession-proof.
It's a remarkably stable source of income because government spending usually doesn't fluctuate wildly like consumer spending does during a downturn.
Our source even notes that, yes, some money trickles down. These companies hire people, buy supplies. But the main benefit goes to the owners and investors.
Indeed. It's often considered maybe the most stable, most dependable income stream you can find during a recession. Unlike consumers or other businesses who cut back, governments tend to maintain, even increase, their spending, especially during recovery efforts or crises. So it's about strategically tapping into that reliable, large source of demand that stays active even when private markets are dead. These contracts often mean long-term, low-risk, high-volume work. Provides a real foundation of stability for big companies in turbulent times.
Okay, from services and infrastructure, let's talk physical goods. Stocking up on raw materials, anticipating rebound demand. This one requires real foresight about economic cycles.
This strategy is about grabbing an opportunity that only really exists when demand, and therefore prices for essential commodities, just collapse during an economic freeze. When economies shrink fast, consumers and industries drastically cut back on buying raw materials, things like oil, gas, iron ore, copper, lumber, even basic farm products. So prices fall, often way down, just because demand is dried up.
But crucially, just because the price drops due to low demand doesn't mean the stuff itself loses its value, right? Oil is still oil. Gas is still gas. People just don't need as much right now.
Exactly. Intrinsic value remains.
So the rich, the ones sitting on cash or able to get cheap loans, they step in. They buy huge quantities of these materials and store them. They invest in storage, maybe renting giant oil tankers, warehouses, knowing these temporary low prices won't last forever.
Precisely. Then they just wait for the recession to pass. When the economy starts recovering, maybe even just shows signs of life, demand for these materials bounces back, often really quickly. Prices shoot up. That's when they sell the materials they've been storing, sell them at a much higher price than they paid.
Buy low, sell high on a massive scale.
Exactly. Capitalizing on that temporary market distortion caused by the downturn. It takes serious capital to buy and store this stuff, but the potential profits are enormous because they basically locked in future gains during a time of widespread economic gloom.
This next one really highlights adaptability, foresight in a powerful way. Investing in businesses that thrive in a recession. The new wave. This isn't about propping up old industries. It's about spotting and getting into entirely new sectors, new startups that actually get stronger because of big economic shifts. What stands out to you about this one?
What stands out to me is that ability to pivot, to see the new opportunities emerging from the chaos. Because every major downturn, every big economic shift tends to create a new generation of successful businesses. Things that meet new needs or change how consumers behave. Think about after the 2008 crisis. We saw the incredibly fast rise of companies like Uber, like Airbnb.
Right, the sharing economy took off.
Exactly. They offered more flexible, asset-light, often cheaper ways to get around or find a place to stay. Perfectly matched the post-recession mindset.
And more recently, during the pandemic, even as traditional businesses were getting crushed, some areas just exploded. E-commerce, especially for groceries, food delivery, went through the roof as people stayed home.
Absolutely.
Online entertainment, streaming, home fitness, huge surge in demand, changed habits, created new market leaders. These were businesses that were either recession-proof or even recession beneficiaries.
Precisely. And looking ahead, our source suggests smart investors are now really focusing on things like AI and automation, understanding that efficiency, cutting costs, becomes even more critical during and after recessions.
Makes sense.
Also, biotech, longevity research, anticipating a future where health, extending lifespan will be huge priorities. The point is, the wealthy are always watching startups, emerging tech, often through venture capital or private equity, looking to get in early. They're hunting for the next big thing that will reshape the market after the dust settles, knowing that getting in on the ground floor can lead to exponential returns, way beyond traditional investments. It's about seeing where the economy is going, not just where it's been.
Okay, finally, within our main strategies for individual wealth building, we have purchasing luxuries when others are forced to sell exclusive acquisitions. This isn't just about buying nice things. It's about getting your hands on incredibly rare, super valuable items, art, collectibles, amazing properties that almost never hit the public market.
Yeah, this is a really unique opportunity that only severe recessions, especially ones that hit certain segments of the super rich hard, can create. Think about truly exceptional art, ultra-rare collectibles like a one-of-a-kind vintage Ferrari, a famous diamond, or those absolute top-tier trophy properties. These things almost never become publicly available. They're held for generations, maybe traded quietly within a tiny exclusive circle.
Right.
But a really bad downturn can sometimes force even other wealthy people to sell off some of their most prized possessions, maybe to cover huge losses elsewhere, deal with cash flow problems in their businesses, meet massive margin calls.
And that's the moment. The rich, the ones with cash ready, step in discreetly. They might finally get that rare Picasso they've wanted for years, or that mythical Ferrari 250 GTO, or that incredible estate in the perfect location. It's capitalizing on the financial pain of others, but at the very, very top, most exclusive end of the market, turning someone else's crisis into a rare personal acquisition opportunity.
And what's absolutely critical here is understanding this idea of exclusive market access. These premium properties, these ultra-rare items, they almost never show up on Zillow or in a public auction catalog. High-end brokers, art dealers, luxury real estate agents.
And they
maintain these carefully guarded lists, curated lists of pre-qualified known potential buyers.
the inner circle.
Exactly. These elite clients get notified first, very discreetly, that something might be coming available. They get the first shot, the exclusive chance to make an offer or express interest. Only if that first wave of super-connected, wealthy buyers passes on it, which is rare, only then might it ever reach the broader market. It's a very closed ecosystem for these kinds of deals. Makes the opportunities almost invisible to outsiders.
All right, now for a bonus section. This takes us beyond individual strategies and looks at the bigger picture, maybe the more profound implications. Recessions determine the New World Order cycles of power. Now, before you reach for the tinfoil hats and start thinking about secret groups pulling strings, let's be really clear, this is not that.
No, definitely not conspiracy theories.
This is about fundamental macroeconomics, geopolitics, patterns you can see throughout history.
Indeed. The more you study economic history, the more you see these undeniable cycles. We won't get super deep into things like long-term versus short-term debt cycles right now. That's a whole topic itself, with the natural ebb and flow of credit and investment over decades. But the key takeaway is that these long cycles tend to end in major realignments. History shows that roughly every 50 to 100 years, there's a fundamental shift. One dominant global power starts to fade, another one starts to rise.
Not just small changes, but fundamental resets of global influence.
Exactly. A really clear example is right after World War II. The United States emerged as the clear #1 global power, economically, militarily, politically, dominant. And this gave the U.S. huge financial advantages, shaped the whole global financial system.
Right. The U.S. dollar became the world's reserve currency, the standards for trade, finance, what central banks held.
And then in the early 70s, when the U.S. went off the gold standard, it essentially gained massive flexibility. Some call it playing with cheat codes. It could print significant amounts of money to manage its economy, fund its global role, and for decades, the dollar largely held its value worldwide because everyone needed it, because it was the reserve currency.
A system that's been incredibly good for the U.S. for a long, long time. Huge economic benefits.
Immense benefits. However, our source suggests this era might be nearing its end, that China seems increasingly poised to potentially reclaim that #1 spot. And it's worth remembering, many people don't realize, historically, China was a dominant world power, economically and culturally, for much, much longer than the U.S. has been.
So this potential shift back, it carries huge implications. Potentially unsettling ones, geopolitically and financially.
And here's the uncomfortable pattern history shows. These massive shifts in global power, they don't usually happen peacefully. They're often triggered by or deeply connected to major global conflicts or really deep economic depressions.
Statistically, we seem to be nearing the end of one of these long cycles. Big changes on the world stage feel overdue, maybe?
It feels that way to many observers. And the moment China were to truly overtake the U.S., If the yuan, for example, became the new global reserve currency, the consequences for the U.S. financial system could be catastrophic, possibly a rapid collapse.
Which would leave the U.S. facing a stark choice, almost unthinkable.
A terrible choice.
Mm.
Retaliate militarily to try and hold on to dominance, or accept a new reality, a potentially less dominant place in the world. It's deeply unsettling to even consider.
And there's another correlation history shows pretty clearly, right?
Yes, a widening gap between the rich and the poor within nations. That often correlates strongly with a higher chance of social unrest, instability, and ultimately even war.
And what are the early warning signs we tend to see historically?
Usually things like a general sense of unease, growing discontent in the population, a widespread loss of trust in government and institutions, and a significant rise in populism, nationalism, sometimes quite radical forms.
Trends we've arguably been seeing grow around the world quite intensely over the last decade or so.
It certainly seems that way. Now, obviously, we don't have a crystal ball. We can't predict the exact future. But it does feel like we might still be in for maybe a couple more of those once-in-a-lifetime events that fundamentally change the world.
Whatever happens, though, our hope for you, the listener, is that by understanding these powerful underlying forces, these historical cycles, you'll be better equipped, better able to find your place, adapt, maybe even thrive in whatever this evolving world looks like.
Knowledge, especially in uncertain times like these, really is power.
So we've covered a huge amount today, a real deep dive into how the wealthy navigate and, yes, often profit from economic downturns. We looked at everything from using government bailouts and bonds to more aggressive moves like shorting markets, buying assets cheap in fire sales. We saw how they optimize things through relentless renegotiation, grabbing low interest rates, how they protect against inflation by moving money or diversifying into safer assets, and finally, exploiting labor market shifts, grabbing government contracts, stockpiling materials, investing in the next wave of businesses.
And occasionally snapping up those exclusive luxury items.
Right, and these aren't just theories. As the example showed, these are active, effective tactics being used.
And understanding these mechanisms, these forces shaping things, it's just crucial for being well-informed. Doesn't matter what your own financial situation is. It gives you a deeper grasp of the dynamics, especially during downturns, sheds light on those often hidden ways wealth is accumulated. Which I think raises a really important question for you, listening right now. Having heard about all these strategies, how might you apply some of the underlying principles? Principles like foresight, resilience, strategic negotiation, spotting opportunities. How could you apply those in your own life, even if you're not super rich? It's about seeing patterns, understanding leverage points, wherever you happen to be.
Exactly. That's the real takeaway, isn't it? Thank you so much for joining us on this deep dive. We really encourage you to keep thinking about this, keep exploring the information, maybe consider how these patterns of wealth accumulation, global power shifts might change how you look at the economic news you see tomorrow and how you decide to prepare. Until next time, keep thinking, keep learning, and keep thriving.